class, we are going to continue this module, and we are working on Chapter 15, Understanding Accounting and Financial Statements. I have to say, this is my favorite. As a CPA, I think promoting accounting in every way possible is what I live to do. But we're not going to get deep into accounting because this is not an accounting course, but we are going to understand the really how important accounting and knowledge of accounting is in business. So you don't have to be a CPA to understand this chapter, and believe me, it will be an overview of some very, very interesting things. So we're going to discuss the user of accounting information, describe some accounting professionals, identify the foundation for the accounting system, and this is the information system. Um, Outline the steps in the accounting cycle, and each one of these learning objectives is probably a very huge overview of the accounting process. We are not digging heavy and deep into accounting. We're not intended to make you CPAs here. Um, we're going to explain what financial statements are, what they do, and do some financial ratio analysis and the nodal role of budgeting. Again, we're going to do an overview of all of these different topics, great and interesting topics. Nevertheless, we're not going to get so deep into them. Therefore, just understand that the limitations of what we're going to go over. We're not going to go over every minute detail of accounting. We're going to go over outline the international accounting practice. And again, this is a big deal because most businesses in some way are being faced with the international arena. We are dealing with a global society, and transactions are going to be across our borders, and understanding the international aspect of it with respect to accounting is kind of important. So, accounting is that process of measuring, interpreting, and communicating financial information, enable people to make decisions. What we do as a CPAs, we want to help others make decisions. We do it through the interpretation of financial information. That's the bottom line. We have a specific set of users that are typically interested in financial statements, which some of which are located on your screen here. Officers, stockholders, creditors, etc. Some of them are internal to the organization, some of them are external to the organization, but nevertheless, they are very interested in the financial information that you provide. And the whole point of it is to evaluate an organization. Really, internally, is to manage. For managers, is to control and plan. Union officials, employees, they really want to be important part of the negotiation process. And lenders and suppliers, they want to make certain that you are financially able to pay your bills when due. That's quite important. Government agencies, etc. Obviously, if you're doing initial public offering, or you have tax issues, that type of thing, government agents are quite interested in your financial statements, and they use that information for their own purpose. But at the end of the day, accounting allows them to make informed decisions, and it's the key is informed decisions. Open book management. Well, we are also trying to make certain that we make clear to everybody this is where we are. This is the organization's finances. These are what we're trying to accomplish with this information that we have in front of us. So it's not always required, but it's certainly a good thing that you can share, even an overview how to use financial statements and how this organization is going. So sharing information like that is very, very important, and it's not always required, but it certainly does help the employees understand where the organization is going and how they are making use of their resources. Business activities involving accounting. Well, as you know, we use it for financing, we use it for investing, and we use it to operate day-to-day activities, selling goods, services, that type of thing. Paying for vendors who provide us with the supplies we need in order to provide service to our customers. Investing, meaning we are acquiring assets in order to make the business grow. Really, to invest in long-term activities, helping the owners make the most money. I mean, it's all about shareholder wealth. Financing is also allowing the business to start, but also help it to grow if you decide to use financing as a tool to grow. And we'll talk about that a little bit in future chapters. There are accounting professionals. I'm a CPA by trade. I am a government accountant as well. But there are a host of different positions that require accounting professionals. Not all CPAs, but nevertheless, we do have an understanding of the auditing, tax, and consulting aspect of accounting. But we also manager accountants, really like controllers, etc., understand the specifics of the organization and how they run and the treasury functions as well. Accounting depends on GAAP. GAAP is the generally accepted accounting rules. It tells us what we do, how we do it, and how it's to be done, and why it's to be done, and when it's to be done. The Financial Accounting Standards Board is responsible for setting those with the oversight of the SEC. What they do is they generally um, evaluate different types of transactions and evaluating the different types of events that will have a financial accounting effect and tell us CPAs how to record them. SOX is also another act that governs the accounting, and that's really about fraud in public companies, rotation of CPAs, and other type of internal controls that ensure people who are not stealing from the organization. The Oversight Board does set standards for auditing, and an auditor is not the accountant for the organization. They provide a report that says that the organization is doing things fairly and their books that can be relied upon. But also, we want senior executives also to be an important part of this because they have to certify and say that these financial statements are absolutely correct. So we are looking at a changing world here in accounting, more in transparency, more in accountability for others, not only the managers and leaders, but also the top board of the directors and those individuals who are involved in the organizational shifts, how organizations move, how they grow, and the type of transactions that they record in their books and the people that they hire. So it's more than just having a bunch of CPAs in a room. There's a lot of individuals who are non-CPAs are going to be involved in this process. The accounting cycle includes activities that convert information from transactions into the financial statements. And one thing could be paying a bill. If you pay an electricity bill, you get an invoice, you pay that. Getting that information on the system is going to be a recording transaction. Knowing how to classify that particular transaction, whether it be utilities expense, rent expense, that's in one part of it. And then summarizing it in the journal is the way we show how we recorded those transactions. We then use it as information to prepare various types of reports, some of which are on the side next to the arrow going down / financial statements. The balance sheet gives us an overview of the organization as of a point in time. The income statement, it just tells us the net income for a period. And then the statement of owner's equity does tell us a change in equity. And the equity is how much the owners have grown or not grown during the period. And statement of cash flows is another important statement, and it does tell you the inflows and outflows of cash during the period. Very important information when all of these items, all of these statements are taken together. So, real quick, assets equals owner's liabilities and owner's equity. What does that mean? Well, we are going to make certain that we understand how this whole accounting thing works. We know one asset is something that you own or you can control. So if it's not owned by right, if it's leased, even a lease is a asset. Why? Because you can control it. So anything that you own or lease, and anything that has a claim against you is going to be your liability. Also, the equity is going to be all the claims against the assets. So a liability is a claims against the firm's assets by a creditor, and an equity is a claims for the assets by the partners or stockholders of a company. Basic accounting equation just gives you an idea of the relationship of assets is going to include both the liabilities and the equity of that firm. Double entry accounting does allow you this. It just states simple as that the debits have to equal the credits. And we're not going to get into what a debit and a credit is, but understand how transactions are entered into a financial system that provides you with the financial statements that you'll need to make decisions. Technology is so huge now. We talk about QuickBooks, we talk about Peachtree. All of these software packages have one thing in common. They allow companies of different sizes to process their accounting information in an automatic way. Very, very simple. It allows them to do certain types of transactions, accounting transactions, that allow organizations to prepare reports that are used for decisions, all in accordance with GAAP and FASB. The balance sheet, as we said, it's going to be the first financial position as of a specific date. So it tells you together what the composition of the assets along with liabilities and equity. And it most certainly follows the accounting equation. Assets must equal the liabilities and equity. This is a structure of a balance sheet. And don't get so hung up on all of the details here. Get an idea on the big picture first. A balance sheet is going to have your assets, both current and non-current. It's going to have your liabilities, both current and non-current. And then it will have your equity. And the stockholders' equity is going to vary depending on the organization structure. If it's going to be a sole proprietor, it's going to be the owner's name. It's going to be a partner, it's going to be a list of the partners. If it's going to be a corporation, it will be the retained earnings and the stockholders section. The income statement is revenues and expenses over a period of time. It is going to be the financial performance. It provides profit and loss. Very important. And here is a structure, a comparative income statement. And again, it's going to show you the overview of very specific categories: sales, cost of goods sold, operating expenses, and depreciation. These non-operating expenses are going to be the reduction in the value of any kind of plant, property, and equipment. They mean the allocation of those costs over a period of time of that asset being used. Operating expenses is going to include the salaries and wages and all of those things that actually are needed to run the organization. Statement of equity just shows how the equity has changed from one period to the next. It is equity. It's going to be the owner. Again, the components of equity depends on the structure of the organization. If it's a corporation, obviously it's going to have retained earnings. It's going to have common stock. If it's a partnership, it's going to have the partnership names and the changes in their partnership accounts over the period. You have to deal with net income because income is going to increase the equity. The cash dividends are going to take away or decrease equity. Here is an example of what a stockholder's equity statement looks like. Very, very straightforward. And again, it's just telling you where the changes have occurred in equity from one period to the next. Statement of cash flow. I love this one because it does tell you how cash is used, and it does explain why your net income is so high but you don't have a lot of cash. And it does show what happened to the cash. The inflows of cash, meaning cash receipts. The outflows of cash, meaning cash payments. I love a statement of cash flows because it answers so many different questions about the sources and uses of cash. Accrual method allows you to record transactions when they occur and not necessarily when cash is paid out. So we're not dealing with when cash comes in, when cash goes out. We're dealing with, have we earned the money have we earned the revenue? Have we actually incurred the expense? Statement of cash flows is a copy of that, and here is the major components. One component is going to be cash flows from operating activities. That's in section 1. Section 2 is going to be the investing activities, and section 3 is the financing activities. And again, don't get so in depth with all of the details. This is way beyond the scope of the course, but understanding the structure of the statement of cash flows, understanding what the statement of cash flow provides is more important than how to prepare one, because we're not asking you to prepare a statement of cash flows in this course. Ratio analysis allows you to analyze various things. One is liquidity, how much cash, how they use their liquid money, cash currency to pay bills or to receive revenues, cash receipts from their customers. It assesses profitability, and it does show their leverage in terms of equity and liability and the effective use of that money. So here are categories of the different ratios that we use to analyze a company. But these ratios are important, and calculating them correctly are important as well. But more important than that is using these ratios in light of companies that are comparable and the industry as a whole. These ratios on their own do not, under no circumstances, so these ratios do not on their own, I have to repeat, these ratios do not on their own tell you truly what's going on. They must be compared. Now, getting the current ratio and the number gives you a high current ratio. On its face, it says something good about how well you can pay your bills and how liquid you can convert how fast you can convert your your assets to cash. That's a good thing. But if you compare it with an organization of similar size and of similar organizational structure, meaning the same kind of business or industry, and you see that your ratio is far lower, that number that what's thought to be a good number really isn't a good number. So the key to financial ratio analysis is not just calculating correctly, but comparing it with organization of similar size, because you truly can understand the measure and the reality of how important that ratio is when you compare it with something else. So current ratio and the inventory turnover ratios are good indicators of how well you're using your assets, but they really make more sense and they're much more useful when they're compared with other companies, competitors, and the industry as a whole. So never look at these profitability and leverage and efficiency and liquidity ratios on their own. By all means, use them as a tool to compare with something else so that you can see from the big picture whether or not this organization is doing well in light of industry, in light of competitors, and in light of organizations of similar size. And there are the calculations. I will suggest that you memorize this. This is not something that's going to be a huge part of your grade, but just memorize it, because when you're in business, whether you're a CPA or not, you still need to be able to have some understanding of how financial ratios are used and what they mean. Interpreting these ratios is so important, and people get so enamored with how to calculate, and I applaud that. But more important than how well you calculate is how well and how accurate your interpretation of those ratios. Because when you're talking about using accounting information for the sole purpose of allowing individuals and internal and external make decisions, interpreting these numbers is of utmost importance. And this is just giving you what these items are and where to find them on the balance sheet. But my emphasis will always be calculating them correctly and analyzing them correctly. They both work together and they're critical so that the others who are using this information can make the best decision. We want them to make informed decisions. Whether we should lend you money, whether we should not lend you money, whether we should invest in your organization, whether we should not invest in your organization, whether you have the means to grow in this capacity, or you're at a point where you need to stand still because the economy is not sufficiently strong enough to support what you're trying to do. These decisions cannot be made in isolation. They have to be made in a big totality. That means these ratios have to be evaluated in a bigger picture, in a bigger context, and they have to be interpreted correctly so that the decision makers who are relying on this information can make the right choice. If they knew all the information, they can make the right choice. If the information is prepared to them in a way that makes sense and is understood, they can make informed decisions. So we have to help them make informed decisions. We're not making the decisions for them. We're just giving them good information, reliable information, and our interpretation of what these numbers mean so that decision can be made and it can be an informed one. Same with activity. All the ratios in all, I suggest you go over them and just understand how they're calculated. But more than that, not just calculating them correctly, but understanding how they are interpreted. How can you interpret the gross profit margin? What relationship does that have to the net profit margin? And what relationship does that have to return on equity? Again, profitability ratios are very important because they tell you the performance of the organization, how they generate revenues and how they use revenues in excess of their operating costs and other expenses. And that's important. Leverage is going to be how they rely on debt. Do they have debt? And again, it depends on who's looking at the information, but we truly need to make certain that when we calculate our leverage, can we compare this real good number to an organization of similar size, or an organization or a competitor, or the industry as a whole? That will take a totally different picture than looking at the organization all by itself in isolation. And that's the key that I'm trying to point out here. We don't want to be in isolation when we're evaluating ratios. They must be compared with others outside of the organization to get a clear picture of whether or not the organization is doing well or poorly and why. Budgeting is a big part, and then it does allow organizations to control and to plan. They may want to do things in the next 4 or 5 years. Budgeting allows them to do that. They allow them to estimate and project expenses and cost inflows. And these are like a blueprint or a map that guides them as to what direction they should go in and what will happen if they went in a certain direction. Again, this is all about us as accountants, business leaders, to help others make decisions. And budgeting is a more of an internal management tool that helps managers, leaders, and the board make the right decision about the firm's finances and what direction they intend to go in. In front of you, you'll see a copy of a sample budget. This is not the only way budgets are presented. This is just one example. Budgets can take so many different forms. And using QuickBooks, Peachtree, and other software packages, you can create budgets within your accounting system, which is extremely convenient. International accounting, as I mentioned before, we're talking about organizations that are now being pushed into the global scene, not simply because we want to, but because of the nature of internet and all those type of things. We're dealing with transactions outside of our borders. That being said, accounting is going to change, and it has to change to accommodate this increasingly mix between the United States, generally accepted accounting principles of the United States, and the international standards. As it stands right now, there are some major differences between the two, and oftentimes it has to do with exchange rates or how certain transactions are recorded. But at the end of the day, we are starting to see FASB and the International Accounting Standards Committee move more and more closer together to have a more international and uniform manner in which accounting transactions are recorded. And it's a good thing, because we are all doing the same thing, and we just do it in a different country. So that shouldn't be too much of a difference as to how certain transactions are recorded. And this is just giving you some idea about how things are moving and what effect it'll have on accounting professionals. So this chapter is a good overview of the accounting function. Accounting is the business language, so it is critical that you understand it. Not to be CPAs, not to aspire to be CPAs, but to understand the role of accounting, what it does within the organization, what its limitations, what its strengths are, and how business relies on the accounting function. As I mentioned before, thank you very much for listening, and I will talk to you later. Thank you.